today, what we're going to do is we're going to go even one level more of sophistication. Now, whether or not you have a philanthropic bone in your body, you're going to enjoy the talk today, because what we're going to be talking about is gifts that provide income. And so, Jim, talk about a little bit about what you do, and it's all yours.
Well, thank you. And first of all, thank you for what you do here, Peter, with these seminars, these presentations. I've known Peter for many, many years, and I just think this is one of the nicest things that is offered for people, that they can come, no axe to grind, you just get solid, straight information. And I applaud you for investing the time to just learn. So it's an opportunity and a privilege for me to be here today to talk about another company.
People have nothing else to do.
Okay, yeah. Then if you don't have anything to do, please be a volunteer at Mission Hospital. I'm just glad I'm not over in that class. That looks a little bit dicey over there. They're swinging swords. This is going to be very deep. Peter said a higher level in terms of sophistication. I always use terms as far as the level of water. When I was a kid, I took swimming lessons at the YMCA, and I didn't have everything down pat, mainly the breathing. Okay, so at the end of the thing, they drop you in the deep end, and you have to swim. Well, I just paddled, and I just prayed that I was able to get to a level that was a little bit not as deep as where I was in, and I was able to get there. So it's a deep water. We're going to go into a lot of deep water now, and any one of these could take 2 hours to go into detail. Please feel free to ask questions. I'll either do one of two things. I'll either answer it right away, or I'll say, I'll be getting to that in just a moment. Now, if you notice that after a few moments, I haven't gotten to it, please do not ask again. That's just my polite way of saying I don't have the answer. Okay? I'm human. But I know with this gentleman here that if there's something that I do not know, he knows it. So we're pretty well covered here. Also, another interesting thing, I'm originally from Philadelphia, which accounts for the accent, and I came to Orange County 25 years ago, and I was amazed. I did some studying and checking out with statistics and things like that, and I learned by my surprise that mortality rate in Orange County is 100%. So it's a good thing that you're going to this, all right? All right, so everything we're going to be talking about today has a charitable aura to it, to one degree or another. Now, Peter hit the nail right on the head. Some people are not charitably motivated, and that's fine. Some people are charitably motivated for their university or their favorite mission organization or their church. It doesn't matter. I'm a person who believes in philanthropy because I know it works, and I believe that things that done on the private sector in that arena do much better. They're more efficient by and large. So everything we're going to. What do you think? What is the #1 charitable group in the United States? Where people give the most money to?
The Red Cross?
No.
Community chest?
No.
Church.
Church giving is up there. And
2 minutes before you die.
Yeah. But what I'm going to be going through here very rapidly, and then Peter and I have not done this. This is going to be a dog and pony show, so I don't know how much of the dog or how much of the pony you're going to get, because he likes to take center stage, so do I. So we might be duking it out here. Very quickly, you're going to go into something next week about IRAs. Just for your information, if you are considering some type of a charitable bequest, and I don't blame Mr. What's his name? Mormon. What's his name?
Buffett.
I'm only kidding. A lot of people say, you know what? I'm well heeled, but I do not want to. I don't know what's going to happen. It's uncertain. So therefore, I'm going to do my charitable giving at my death, and that's perfectly okay.
How do we know when is the death?
Excuse me?
How do we know when the death is coming?
As I say, all I know is it's 100%. I don't know the timing. I just know it's 100%. But when you're considering, the disposition of an IRA, you may want to look at that as the component in which you carry out your charitable giving at death. Why? Well, because IRA assets are subject to, there's a whole lot of, we've got the IRS, we've got the IRA, we've got income in respect of IRD, income in respect of a decedent. It's just, and I'm not going to go into detail, just by the nature of that asset, it is subject to potential double taxation to the heirs. I don't want to have to go into details, but you can escape that if you have that going to charity. So let's say, for the sake of argument, part of your estate is $100,000 of XYZ stock and $100,000 in your IRA, okay? And right now you have, because you've been told it's always better to donate stock because you avoid the capital gains tax, and it's true during lifetime. But in your mind, you say, I'll give the stock to the charity and I'll give the IRA to my children. You probably would be better off doing it the other way around, okay? Just like I said, conceptually, all right, does this work every time? Is this all the time, works all the time that way? No, every situation is different. You're all like snowflakes. You have different situations.
You're going to give the reason?
No, because we don't have enough time. I mean, like I said, there's so much that I just want to give ideas here, little stars. If something should ignite there, you could talk to Peter. I will give you right now on the front. You can write this. You have my cell phone number. Very few people have that, and if you call me after 10 o'clock at night, I'm not going to be a happy camper. But let me give you my email address. It's JIM. F as in Frank, REY at stjoe.org.
Can you repeat that, please?
Peter's written it down. Oh, you didn't write it down. What are you doing here? Okay. I thought you were writing. It's JIM dot M. That's my name. Jim. It's not Jim. All right. Jim.frey. This is going to be a long session. Yes. Fry. REY. At. ST as in Saint.
ST as in Saint.
JOE. .org. Yeah. If you have any questions at any time, please feel free to email me, call me, or whatever the case may be. And also on the very bottom of here, I gave you a direct link to our website, which is our gifted estate planning website. It's just tons and tons of information that you can sit down, read, and ask and whatnot. So let's continue on. And that's why I don't want, there's going to be a lot of stuff here. Like I said, the water gets very deep here. All right, first, and what Peter said earlier is that these types of gifts, with the exception of what we just talked about, everything we're going to be talking about provides a now benefit either to you or to your estate. One of the most simplest in terms of in the whole arena of life income gifts, which is a very complex arena, one of the simplest ones in that whole ball field is a gift annuity, charitable gift annuity. Now you're going to notice something very consistent with all of these things that you're going to see here. You're going to see 3 boxes. And it's a very nice way of kind of just tracking what happens to the asset. Now, with a gift annuity, charitable gift annuity, a person makes a donation to the organization. Organization takes that money and puts it in a special reserve account and then pays the donor or donors, if it's a single person, husband and wife, life income for the rest of their life, guaranteed. Now, how does this all happen? Is this some kind of magic? No. It's done with actuarial calculations, present values, and all of that stuff, and reserve accounts. In the state of California, and it's very important for you to know this, in the state of California, any organization that issues or claims to be issuing this must be certified, must be licensed by the state of California. And if, let's say, you like this idea, and it's kind of strikes a chord with you, and you have like the Deformed Puppies Association, and you want to, and they have a gift annuity program, make sure you say, are you licensed? Have you been approved by the California Department of Insurance? And if they give you a blank stare, they don't have it. So can they issue a gift annuity? I guess they could, but it's illegal in the state of California. Why? Because the state of California Department of Insurance is looking after you. Because what happens is that they make the charity set up certain reserve requirements so that that annuity is going to be paid. Now, in this particular case, John, I got to print these things larger. This is too small for even me.
I can't even read it.
Yeah, okay, I apologize. Next time I'll do it 2 per page, okay? I was just trying to save trees, okay? I'm a greenie, what can I say? But here we got John, and he gives $10,000. He receives income at 6.5% for the rest of his life. A good portion of it is tax-free. So you can see there, he gets $650 and $473 is tax-free. So his effective rate, right, follow me on this because it's a matter of just playing with the numbers. The rate that he gets is 6.58%. But because a part of it is tax-free, at the end of the day, what I always say is, how much do I have to buy beer and pretzels? Because beer and pretzels is the only thing worth living for, right? And dark chocolate. So how much is left at the end of the day? And I do this thing, it's a chart where when I'm talking to an individual where they have, say, a CD or something like that, I say, what are you getting with the CD right now? I was getting 3%, now they're going to give me 2%. I say, okay, let's look at it. We go down here. All right, if you get 2%, how much you get? One of $10,200. What is your tax bracket? So we do the calculation. Say, okay, after taxes, the net spendable is X. But when you have something that's paying 6.5% and about 60, 70, or 80% of it is tax-free, that has a very powerful impact on how much you actually walk away with. Another important thing to remember is this tax-free element. It goes for a certain period of time. And that's basically your actuarial life expectancy. Because we do have calculations to say if you are 65 today, based upon actuarial assumptions for all people age 65, your life expectancy is 18.6 years, all right? Does that mean that at 18.6 years from now I die? No, only if God says it. But the actuarial tables just take a look at all numbers. So you get partially tax-free income. It's guaranteed, depending upon a person's age at the time they go into it, and you get an income tax deduction because you are making a gift. Because with this $10,000, if a person was charitably motivated, they could say, you know what, I'm just going to give it to the church. $10,000. How much of an income tax deduction does that person get for having made a $10,000 contribution? Anyone? All right, we got a good group here. With that same scenario, if there's a string attached, I'm getting something back. Well, you're not going to get the $10,000 because the IRS, they're not as stupid as they appear. They're going to say, well, wait a second, you haven't really given $10,000 outright. You retained a lifetime income, so therefore your deduction is going to be limited. And so in this particular case, his deduction is $4,418. Now, I think I guessed at this, that is, I used for this calculation, his tax bracket. Because your tax bracket is very, very important as to the value of an income tax deduction. So if you're in a 15% tax bracket, it doesn't have as much meaning as if you're in a 30% tax bracket. And I'm talking about combined, state and federal. That's the gift annuity. The next one, we're going to go real quickly because this is a husband and wife. Can we do that? Yes. And the numbers look the same, except that it's a little bit lower. Why? Because we are guaranteeing income for 2 people. So we have John in the first one there, 6.5. John and Mary, 76 and 76, 5.8. And then if you go to the next page, we've got John a few years later at age 84. And lo and behold, it's 7.9. That's not too shabby. So when I'm talking to people who are in their late 70s, mid 80s, and they've got CDs, and they're just, I don't know what I can do, this kind of registers, okay? So here it's 7.9%. Now if it's John and Mary, it's 6.9%. So these things are pretty well self-explanatory in terms of all 4 of those all 4 of these illustrations, okay? The concept is the same. Separate, they make the gift, income, ultimately gift goes to the charity. Because we're going to be looking at another family of life income gifts. you make this gift to that organization, you don't have a lot of flexibility because it's a contractual arrangement where you say, I give to you, charity, and charity contractually agrees to that. And then what happens is that when the obligation to pay income no longer exists, i.e., your actuarial lifetime actually does happen, then that is freed from that reserve account and it goes to the charity. Is it $10,000? More than likely, no, because there could be 5, 10, 15 years that goes from the time you take out the annuity to the time you pass on.
Jim, is there any cost to give you a call and say, hey, I'm considering a gift annuity for $5,000 or $10,000. I want an illustration like this, and tell me what amount is tax-free, how much is taxable?
Yeah, the illustration that Peter's referring to is, no. Again, you can even do that if you wanted to. You can go to our website and you can do the calculations for yourself. We have it on our website. I'm a firm believer that people just need to know what's out there in terms of choices and investments and things like that, and giving. So if you know what you can do, then it helps you to make a decision, okay? So yes, if you call me and say, well, how does that work in my situation? You give me your date of birth, I send it out to you, and that's fine. And if you say, I like this, you give me a call. If you say, okay, nice, but I'm not interested, nothing. But the important thing is to have that information. So if you like the concept, be happy to do the calculations. If you like the concept and you just happen to be married to the University of Michigan, God bless you, and you say, I'd like to do this. Does the University of Michigan have that? More than likely, I would think that the University of Michigan has it. Yes, sir?
If the funding for the gift annuity comes from an IRA, are the tax advantages the same? Or
no, unfortunately. Good question. If you were to transfer money from your IRA to the gift annuity, we're not going to get the benefit, because what that is going to be basically is you're going to have to say, I take out $10,000, I pay the taxes on it, then I give it. A better scenario, and again, you could crunch the numbers here, we run into this quite a bit where people have stock that they've had for 100 years, okay? And it's bleeding out 1%, 1.5%, 2%, and it's gone up in value substantially. So maybe they bought the stock for $25,000 25 years ago. Now it's worth $250,000, and it's still just giving that little drip of income. That would probably be a very good asset to look at in terms of funding the annuity, because what would happen is, if you were to otherwise sell that asset, you would be subject to capital gains tax. However, if you transfer it to a charity, we don't have that capital gains tax.
But on death it would be awesome to do out of your IRA.
Oh yeah, your IRA, yeah. IRAs and charity at death, that's a, and then also currently, as far as and you really have to be philanthropically motivated. If you want to support a charity, they now reinstituted making gifts directly to your charity up to $100,000 from your IRA. So IRAs have good, you can use those things in certain ways, but they cannot be used. It's a good question, a great question. I expect good questions from this side of the room too, okay? Because we've gotten two good questions over here, so we got, but no.
The old divide and conquer.
Oh, hey, listen, I'm going to lean over here. All right, so that's the concept of gift annuity. Now, let's take that gift annuity, that concept, keep it in mind. You give an asset to the organization gives you an income for life, and then at the end of your life, whatever is left in that. Has anyone heard of a reverse mortgage?
Yeah.
Okay, I mean, it's a big thing. Who's the actor now that's trying to sell? I think he gets a commission. Robert Wagner, Robert Wagner, I got a deal for you. Well, I got another deal for you. If that concept makes sense to you, a lot of charities will also take and use this very thing and incorporate it into a twofold gift. Let me explain to you very quickly. It's explained here, all right? So you have some stuff to read over the next three. Let's turn right here, okay, to this one right here. It says Charitable Gift Annuity for Ellen Keller, because this gives you all the lead-in. What happens here Ellen has a house that's worth $800,000. She lives in the poorer part of town, okay? What she essentially does is she creates first a life estate. A life estate simply means this. I decide to give to you, charity, my house, but I reserve the right to live in it for the rest of my life. So the title is actually redeeded so that charity owns it and I reserve the right, okay? Now, both have value. And if you were to stop right there, you would have made a gift that you would have gotten an income tax deduction for. Does that make sense? So we're talking about value. We're talking about irrevocable transfer of assets, the real estate. Even though the charity doesn't get it right now, we again use the actuarial tables. It's all a matter of numbers and calculations. Now, what we do is we take that resulting income tax deduction, and I think it's here somewhere. Life estate. Oh yeah, $595. All right, so yeah, top here, we have. She would get an income tax deduction of $595,000. Well, she doesn't need an income tax deduction. She doesn't have a tremendous amount of income. She's looking to get more income. So what we do is we convert an income tax deduction and put it into the annuity. So what we do is the charity funds the annuity. It's all a matter of calculations and everything, because the charity does have an asset. It's named as the owner of that property. Bottom line is that she winds up with getting $48,000 of annual income for the rest of her life. She has essentially created a reverse mortgage using the gift annuity. So again, I don't want to go into details, but if you know people, if you yourself are looking at possibilities, just have people stop and say, well, are there other ways? Because that's the most important thing you can get from this whole series. Is there another way? How can I do what I want? And what's the most efficient way? And what's going to be best for me? All right? Should always be what's in it for me. I always like to say that in estate planning, the most important entity, not the children or anything, I want to make sure I have enough money for my lifetime. And if I knew exactly when I was going to die, I could probably figure it out that way. So that's, yes ma'am, I'm glad that you finally come over.
I was just wondering, a woman aged 85 and you're selling her an annuity, when her actuarial age has already been reached.
Oh no.
I had 82, I thought.
No, when she's, no, hold on. Good, very good question. No. When I'm 65, actuarially speaking, I'm supposed to die at 82.5. But when I'm standing here at 82.5, they say, oh, wait a second, he made it to that. So actuarially, probably another 6 or 8 years.
There's a joke amongst the fundraisers that anybody who does a charitable gift annuity,
and this is true,
actually lives actuarially 2+ years longer than the rest of the population. It's really true. I mean, the universities, they're sitting there going, oh my gosh, all of our annuitants are over 100 years old.
Okay, so it's a good question. Again, we're looking at just putting little bullet points up here about concepts that are extremely complex, okay? But I want to talk about what would be the benefit to me, all right? What are the hot points? I'm basically a salesperson. I work for a charitable organization, but I'm successful when I am able to communicate ideas and concepts. I'm not successful when I can say, this is what a gift annuity is. I'm successful when I say, let me ask you what your situation is, and then I'll say, well, how about if we could do thus and so? People say, I didn't know I could do thus and so. So it might be a gift annuity, it might be a child remainder unit trust, it might be a child remainder annuity trust, which we're going to be talking about, and the water gets really deep there. But conceptually, yes. So you have to look at these things. Does it work for me? I want you to be able to say right now, and how many can raise your hand, all right? How many of you, is this the first time that you've ever heard that you could possibly have something like a reverse mortgage using a charity? So, case in point, whether or not it ever works out that you do it, that's immaterial. The most important thing is that you know it's there. All right, now we're going to move right along. We still are until 3 o'clock, right? I want to make sure I'm on time.
3 o'clock, yeah.
Okay.
They're serving alcohol.
Yeah. I'm going to do a little side thing here right now, because in the area of charitable giving, many times I work in the area of non-cash. Typically, 99% of what I do is non-cash. It's stock, it's businesses, things of that nature, it's estates. Sometimes when you have a person who is philanthropically motivated, the best asset might be a building that he or she or they own, okay? So let's say I'm at the university and we've got this big building project going on, and it's a $20 gazillion project, and one of our major alumni has many buildings. He has so many buildings he could easily give us one. So what we will do is we'll approach this and say, that you have that bank building that you've had for a number of years. It's completely depreciated, and it's worth $5 million. Would you give it to the university? Sometimes people will say, yeah, I never even thought about that. Thanks for bringing it to my attention. Because they really care about the organization, and the organization has brought to them an idea of just give us the real estate. And so all of the paperwork and everything. Sometimes that may not resonate with me. I say, nah, it makes sense. I would like to do something, but I just can't bring myself to making that gift. So the next thing that might resonate is, well, would you consider a bargain sale? A bargain sale simply means bargain. Now, many of you women, you know what a bargain is. You go out and get it. Men, you're kind of oblivious to those things. But a bargain sale simply means this, that the organization and the donor agree on if this property is worth $5 million appraised value. What's that?
We buy it 10 million.
No, you buy it for less than.
Yeah.
So the donor and the charity agree on a bargain. So it's worth $5 million, and let's say we agree on $3 million. Well, you've just made a $2 million gift.
Isn't it a kind of conspiracy so-called against the government?
No, there's not a conspiracy. The thing is that, as I said before, I think that life is much better run by the not-for-profit sector. And so, let's look at it this way. You've been looking at the broad picture of estate planning. Now, when you start getting into the area of estates that are $10 million or more, you've got an estate tax situation. Think of estate tax this way, because I deal with people that have $50, $100 million estates, and they can understand this very, very clearly. The IRS is good to you in some ways. At death, you, if you have a taxable situation, have the choice of 3 potential beneficiaries: your family, government, or charity. And they say, you can pick any 2 that you would like. Now, given the choice, what 2 would you pick? Family, I would assume? You love the government? You can do that. But what people don't know is that they have a choice. And if it's a matter of giving it to the government or giving it to charity, all I want people to do is know that they have the choice. Whether or not they do it, it's a whole other thing. So that kind of, no, we're not playing the system. It's designed that if people are charitably motivated, there are benefits. And so the incentive is to be philanthropic. So now that didn't work. That idea didn't. Let's assume, okay, I can't give it to you outright. You've talked to me about this bargain sale. I don't quite like that as well. The next thing we're going to talk about is a charitable remainder unit trust. That's that little thing right there. Now, does that look somewhat familiar? Yes. Conceptually, it's no different than the gift annuity. But we have just gone from about, say, 1,000 feet in the water to about 2,500, 3,000. This is very, very complex. There's a lot of moving parts there. Gift annuity, contractual arrangement between you and the organization, okay? When you start getting into a unit trust or a charitable remainder trust, a lot of things are happening here. But let me conceptually try to take that gifting scenario. You didn't want to give it to me outright. for whatever reason, we weren't able to negotiate something with the bargain sale, then I'm going to come to, what is your name, sir? What is your name? Huh? Saeed, let me ask you something. What if there is a way where we could take that property, and I know it's $5 million, and your cost basis is $500,000, and if you were to sell it, you would get clobbered with capital gains. What if there's a way we could put that in a special trust where you still control it, okay, and then we sell the property and not pay the capital gains tax, and we are able to provide a lifetime income for you and your wife? Does that make sense?
Yeah.
I didn't say anything about a charitable remainder trust, but I just explained to you why people might consider a charitable remainder trust, because we can accomplish all of those things. Now, am I helping you solve a problem? Good chance, especially if you've been thinking about selling that property for a long time, but the reason you haven't was because of the capital gains tax. So we've got a fantastic situation of being able to help you solve a problem, i.e., get rid of that property without paying capital gains tax. Now, another neat thing about that is if you look at this, not only do you escape the capital gains tax, but you also create, in this particular case, John and Mary, 67 and 65, $1 million property, they create an income tax deduction of $352,000. So stop for a moment here and look at just the numbers. We've eliminated a capital gains. In this particular case, we've eliminated capital gains of $225,000. These are real dollars, okay? We have eliminated a tax of $225. And we've created a deduction of $352,000. Those are really pretty powerful numbers. And as Peter said, that most people are philanthropically inclined before they go into this. I can tell you as a fact, there are several people over the years that I've been working at, they weren't necessarily philanthropic to begin with, but when they saw the benefit, they say, well, wait a second, so I can do this thing, not pay the capital gains tax, get an income for the rest of my life, and get an income tax deduction? And the answer is yes, yes, yes. Really, a lot of people say, well, the loser is the government. No, because as I said before, if you have a choice of the Laguna Canyon Foundation, the hospital, the university, the church, my goodness, they're doing all wonderful things. Yeah. Okay, they really are.
And the government looks at, they encourage this kind of giving, and the reason for that is, if you send $1 to D.C., and you ask Washington to help you fund a program back home, it's kind of like 50 cents on the dollar. Yeah. Versus giving it directly to a local charity where you have probably 80 to 90 cents working on the dollar. So Congress, and all of these are laws, and they're kind of unique to the United States that encourages philanthropy. But you have to make a conscious choice. Mm-hmm. The government is in, if you don't make a choice, then it's going to be the government. And most people don't understand the tax system. Yeah, they don't understand the tax system, nor do they understand some of the things that we're talking about here. This is all, I would assume, pretty brand new to you. This is overwhelming at times, and that's why I'm trying to keep it as simple as possible in a very complex arena. We got two questions over here. That's good. You guys got to come up here. Yes, you had a question?
What if the property is in another state? Does that come?
Not a problem. The issues that where it's located is not a problem. Some of the issues that we run into, and there are. I mean, let's face it. This is very technical, very involved. Debt can be an issue. It is an issue. So we have to look at how do we get around the debt. And let me tell you this: if the property is upside down, don't think of it. So so debt is a concern as to how to, because of the rules and the regulations. And I don't want to go over the. Don't try to donate timeshares. But we can't go into, at this point, we can't go into all of the what you can, what you can't. I would say when this thing kind of drips down, like it percolates, and say, oh golly gee, give either Peter or I a call and say, I just remembered we have this, whatever it is, okay? But the timeshares certainly aren't. The Maserati, okay? The 1937 Maserati that's just been gathering dust and it's worth $2.5 million. Those types of assets can work. They have a Maserati. I just saw them. But whatever comes into your mind, say, well, wait a second, I have this. Will it work here? I don't know, but ask. The worst that can happen is say, oh no, that's...
You can fund a charitable gift annuity with a piece of artwork, with a unique instrument, anything that's of value.
Yeah, so now again, we're staying in this arena right now of the charitable remainder trust. What distinguishes it? What are some of the things that distinguish it from the gift annuity? The complexity factor, as I said before. Gift annuity, relatively simple. Trust, complex. Control. For those people that I've met over my life who have been very, very successful in their business, they're control freaks. They don't like to give up, and I don't blame them because they've been successful because of that. Well, where a gift annuity is the contractual arrangement between the donor and the charity, what happens here is that you really aren't making a gift to a charity. You're creating a trust. You've had an education already on trust. This is just another trust. What happens is that when you create that trust, just like, well, you erased it. What's one of the things that you have to have in a trust in order to determine who does what and everything? That is called a trust. A trust. Come on, help me out. Trustee. Okay. You got to get a person who's going to say, okay, I'm going to do thus and so because this is what it says to do. Well, golly gee, you could be your own trustee. So, even though the asset has transferred from your hands into this charitable trust, right there, okay? That's a separate legal entity at this point in time. It's a separate legal entity. It's a trust. It needs to have a trustee. It has to have instructions as to what it can do, what it can't do, what it's supposed to do. Well, what it's supposed to do, there's two main things that it's supposed to do. Provide income for the income beneficiaries, which could be you and your wife, and it could also include your children. Oh, I didn't know that. It's interesting. So a lot of additional add-on. It's like when you buy a car, okay? You buy the regular car and say, well, could I add that on? Yes, you can. Does it cost? Yes, it does. So what is the cost of adding children? Well, you have some considerations that you are making a gift to them. So you might have gift tax, you might have estate tax. The point is that you can do it, but like anything else, you just want to know what are the ramifications. And as Peter said, with some of the more I shouldn't say just the wealthy people. A lot of people are concerned about how their children are going to use assets when they pass on. They like the idea of having that instead of one lump sum where they can buy that $250 million or that $2.5 million Ferrari from these people back there, or the Maserati. They like to have income. So you can control through this trust that at the end of your lifetime and your wife's lifetime, that income continue on. So it could go for the lifetime of the children. Or you could say, after we're dead, we'll let it go for another 10 years. So children get income. Now, you might also want to overlay this on other types of distributions that they're going to be receiving. But for that one asset, that thing that's just been sitting out there and gaining value, and the only reason you haven't sold it because it's the capital gains, this could very well be a perfect way. So the control factor, the flexibility factor. Now here's the one thing that I hate to say this. You also control who receives it. The charity. Because see, you are creating this thing. You don't have a contractual arrangement with the charity. You go to your attorney, and he or she draws up everything, and you say, I'm going to name A, B, and C as the charities. A, B, and C may never know about it until you pass on to glory. And then they get a call from the attorney and say, by the way, you were named as a beneficiary. So you control basically the assets itself, because if you're the trustee and you've got this building and then you put it in the trust, you then sell the building, what do you have there now? You have cash. Well, it has to be invested. Now, you yourself may not feel comfortable, but you know people that have the expertise to be able to say, okay, for this particular asset now in this trust, you probably would be better served by a portfolio of this, 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 and this. right? But you're still in the seat. You're still controlling how it's going to be used. So one thing about the charitable remainder trust, flexibility, control. And those are big, big things. You don't have that with the gift annuity, all right? But they both look the same from the outside. Transfer assets, receive income. At death, asset goes to charity. So they look the same, but there's a whole lot different stuff happening. Now, in the arena of charitable remainder trust, we have two families. We have the living unit trust, which is the one that I talked about, and we have the charitable annuity trust. What's the difference between the two? Well, again, we get into fine-tuning here because they'll both do the same thing as far as taking that asset, being able to put it in there, sell it, and not pay capital gains tax. However, with the unit trust, what's going to happen is that every year the asset is going to be recalculated in terms of the value of that asset. And let's just assume that the payout rate that you've selected is 5%. Every year that asset is going to be recalculated. And let's assume that you've been very, very good in terms of your investments, and the investments actually earned 6% total return. Trust has to pay out 5%, earned 6%. What happens? You've got a little bit more money in the pot at the end of the year. So at the beginning of the year, you recalculate what is in the trust, and you get 5% of that new value. So if you're an astute investor, if you put your, you got a good portfolio, and it's increasing in value, you're going to have increasing income. Conversely, if you've been a dud, and instead of earning 5%, it's earned 3%, the assets in the trust are going to go down, and you're going to be getting less income. Well, some people say, I don't like that idea. I like the idea of receiving the income, but I would like to have it paid out no matter what. That's the annuity trust. So in this whole family of charitable trust, we have the unit trust, which has the variableness, and we have an annuity trust over here, which is, I'm going to get whatever the dollar amount is, I'm going to get that year in, year out. Now, are there any guarantees? Because in the annuity trust, let's say we've had a horrible investment, whatever, and it was in relatively safe investments. And 10 years down the road, that $5 million is no longer there. The trust doesn't have anything to pay. So you have to keep in mind that where in the gift annuity, it was a contractual obligation on behalf of the charity to pay that. We don't have that. So management is crucial to a charitable remainder trust. So you're looking at this over a long period of time. It's funny because I've had people say, well, gee, if I can do this, can I have any kind of payout rate? There are certain rules and regulations in terms of what IRS says you can do. And in some cases that people could legally, according to the IRS, have, say, a 10 or 12% payout. And they'll say, well, gee, I want to go for as much as I can. Well, let's just step back for a moment. What is the current environment as far as investments? Where in the world are you going to get 12% safely? So you have to look at these things not in terms of, well, what can I get? But what is reasonable? What, in this current environment, if I want to have 12% and I know that it's probably going to drop down in value, I may not like that because then I'm going to have less money 10 years from now. But if I can say, well, I'm going to be a little bit more conservative in my estimates right now in terms of I'll take a 5% payout with the hope that the investments will earn more than that. The charity itself, that is highly regulated by the Department of Insurance. Like I said, the charity has to set up reserve accounts, and they just can't pick out a number. The Department of Insurance specifies how much is set up. They also specify that the charity must pledge all of its assets to, I guess it's just like a bond, okay? Must pledge its assets to meet those obligations.
So St. Joe would have to sell all of its hospital buildings, etc. Could be completely, totally broke, have no assets whatsoever before they have to stop paying that annuity.
Yeah. Mm-hmm.
Thank you.
But a good question, which begs to, and the Department of Insurance has certain guidelines before they'll even issue a gift annuity. Most of the time, the charity has to be in existence for at least 10 years. They have to be able to substantiate that they're a good, solid organization.
Yeah,
but
you don't see the smaller charities have a gift annuity program. You would go through a community foundation if you wanted to benefit a smaller charity. Do you allow at St. Joe's, let's say, if I wanted to give 30% to the YMCA and I wanted to give 70% to St. Joe's, will you write that?
No. But the question that Peter is posing, that with the gift annuity, where we basically are controlling it, and if someone said to us, I'd like to be able to give it to St. Joe, but would you agree to also give, say, 30% of it to the YMCA or whatever other charity? We do not do that. However, I believe the Orange County Community Foundation does have that type of an environment where you can get the annuity, everything that I just talked about here, and then you say, well, I would like to be able to support 2 or 3 different organizations. So in that scenario, you would have a little bit more flexibility. But some charities will do that. I think the overwhelming majority of them they do not, with the exception of your community foundations. Good questions, though. All right, so we're still in this arena, very deep water of charitable trust. We've got control. We've got issues as far as, do I want to have the income subject to fluctuation? Do I want to have guaranteed income? With the annuity trust, knowing also that this stands on its own. As I said, the big difference between a gift annuity and a charitable trust is that you do have that gift annuity, that charity involved in this scenario. With the charitable remainder trust, you've got the trust. Here, everything, you've poured it into there. It's just like you have your living trust here, okay? And then right next to it, you have a charitable remainder trust. All right? So the charity isn't involved. You're involved. You're managing this during the lifetime of this trust. So a lot of issues, a lot of things that you have to be careful of. But let's talk about other possible ideas, because that's the whole thing. Because I want to talk about the give it twice trust. Oh, I like that. I can give something twice. And again, we're using these tools and applying them to a situation. Many times, people will say, you know what? When I die, I don't want to give everything to Sally and Billy. All right? They're okay, they're good, but they just, they're still, I'm not comfortable with it. So I'll say to them, well, did you have any idea of giving them some type of a lump sum? And they'll say, maybe, $50,000, $100,000, but, I just don't want to give them $1 million. And then I'll say, well, what would you think about an arrangement whereby they would receive income for, say, 15 years, maybe 20 years? And then at the end of that time, you would also make a gift to charity. You would give it twice. You would give the income to your children during that period of time, and at the end of that period of time, it then goes to charity. Well, that is an annuity trust. So people don't buy, or they don't create a charitable remainder trust. They create a trust that helps them solve a problem. The most important thing for an advisor to know is, what is it that you're trying to accomplish? Tell me what you're trying to accomplish, and we'll look at some ways it can be facilitated. Rather than saying, you need this, or you need that. I don't know what you need until I understand what you're trying to accomplish. But these are tools that you may not have ever heard about. They're there, they do work, and in the right situation, they are powerful. They are very powerful. It just depends upon the situation. So, again, we have the give it twice trust, just a quick overview. And we haven't, like I said, I could spend an hour on this alone as far as all the shades and the colors and different ways and different applications. Just remember, you're talking about the transfer of assets either during your lifetime or at death. And so from an estate planning perspective, this type of a trust can be very powerful, because you're saying, all right, Johnny and Susie, I love you, but I just have some concerns, and I want to provide an income for you. I know with my one daughter, she's attention deficit. She's a bipolar, and she's got good control of it. But I just wouldn't feel comfortable in giving her everything. So every family is Every family is different. Every situation is different. The size of your estate, the composition of your family, everything is different. I wanted to make sure that at the end of this session, you have a better understanding of another component that you may not have been aware of. And I also want you to feel comfortable that you have a resource, the website. You say, well, gee, he blew through that stuff awful fast. And yes, I did, by design. We just can't go into detail. But you do have a resource of being able to go there, and you can check with Peter. You can check with your advisors to say.
You know, most advisors don't know this.
And that's true. Yeah.
They really don't.
Yeah.
CPAs don't. Financial advisors don't. Brokers definitely don't, because there's no commission or fees involved.
Yeah.
So a lot of professionals don't have a clue.
Yeah, and it's right. I've been in Orange County for 25 years. A fair amount of my work is with professional advisors. And what Peter says is true, and it's unfortunate. I'm a firm believer that anyone who is in the professional advisory services needs to give their clients all of the options. And if they don't understand them, they're not doing their job well. They don't have to know all of the particulars about it. They should know that it's there, so that when you're looking at the big picture, is a charitable component something that's feasible? Well, if the advisor doesn't know anything about it, he or she isn't going to put it on the table. And I think that is unfair to the end user, to the client.
An advisor never is wrong when they say no.
Yeah.
So I agree with, and I echo his comments there. And it's a delicate balance, because when I'm talking to the professional advisor and someone who is a friend of the hospital says, Jim, I wanted to talk about this and do this and this, and then we get involved with the attorney or the CPA or whatever the case may be, and they're not totally up to speed with it, it's another process to bring them, because you don't want to in any way ruffle their feathers. It's somewhat of a diplomacy 101. But the bottom line is the individual. The individual. And the most important thing is for them to understand what it is that they want to accomplish and the tools that are out there. I just planted some new stuff in my garden, and I used the right tools for it. Okay, I used explosives to get through the clay. All right, we're going one step deeper. Yes, sir.
Sorry, I've got to go backwards. I'm a slow.
That's okay. That's okay.
Okay, I want to go back to Ellen Kelly.
Okay.
The Home Plus annuity.
Yeah.
All right, and in that case, she has a tax deduction of $344,663.
Right.
What if she's only on a retirement income of $36,000?
Okay.
And she owns this home, but that's all she's got.
Right.
That doesn't do her much good.
Well, I agree with you, because
saves her tax for 1 year.
All right, now hold on one second here. So what we have here, now don't forget, we did have an income tax deduction of, let me just get it, yeah, that's true. But now we've increased her income by $48,000. So she might be in a taxable situation. You bring up
Is it in the year of the gift plus 5 years?
Yeah.
Got 5 years?
Yes. No, total of 6.
That's 6.
Gift, the year of the gift plus 5. Thank you for bringing that up, because again, when you're talking, that's the fine tuning. But yes, you might have a situation, even in a situation like this, where they may not be able to use that deduction over the 6 years. But I can tell you one thing, in this particular case, she has $48,000 more of income than she had the last year. So it's a good situation, but you bring up a very good point is, okay, we've got an income tax deduction here, but remember what I said before, if she just stopped at making the life estate, remember I said part of it what she could do, because it's basically 2 gifts. The first gift is called the life estate, and if she just stopped there, she would have a huge income tax deduction, And if she's in a relatively, because why is she doing it in the first place? She wants to get more income. So she probably doesn't have enough income to justify a $500,000 income tax deduction. She can't use it. But what we do is we take that income tax deduction and then we fund the annuity, but we still have an income tax deduction, but now we have more income.
I didn't think about the additional income.
Oh, I do all the time.
Yeah.
Yeah, but no. This is complex, and like I said, there's a lot of moving parts.
No, it's a great point.
Yeah, it is.
The thing about these gift illustrations, if it turns out, let's say for instance her income wasn't, and the tax deduction wasn't any good for her,
yeah,
then from a financial end, this may not be the best thing for her.
You bring up
but you don't know that until you get into the kind of the nitty-gritty. And that's why Jim really isn't a salesperson, because he's not there, even if there's no income tax deduction and your goal was an income tax deduction, that is the worst situation to talk somebody into.
Yeah.
So that's why you got to have these illustrations. They don't happen in a day.
No.
It takes months for somebody to go through the process, understand it.
Whoops.
I mean, these things are complex.
I'll give you a great case in point in terms of the complexity. I'm dealing with a family. Been very, very, very successful in real estate. He's probably 83 now, and been working with him for 8 years. Delightful person, but the issue he had was he didn't think that he thought he was immortal. Okay, just a lot of people are that way. He's very active. He's very engaged in the business. A very spry and healthy person, and he also kept on waiting for the taxes. He felt that the estate taxes would eventually be totally eliminated. So we got together for breakfast about a month ago. And I said, okay. And his son is there. A couple of things I want to... Oh, another thing that's very important to this whole scenario. The daughter-in-law, whose father was very successful as well, died last year. And she's now running the business. It was not good planning. This fella... Two things really struck a chord with him now, okay? I said, listen, here's the deal. You can shelter $5 million. Your wife can shelter $5 million. How much above that are we talking about? And he just looked at me, and I had a pretty good idea. And he says, well, it's substantial. And I know he's probably somewhere in 80 to 100 million, depending upon the value of real estate. Huge estate. He's, like I said, 82, 83. And he also, I says, you also realize that that's what you can do for taxes, and you ain't going to be out. You ain't going to be here for the rest of the year. You know, you're. And I knew this from talking to the son. The impact of having his friend die, because they were contemporaries. It's taken all this time to come to realization. And we're talking about not only what we've just talked about, but the next thing. So that's a beautiful segue into this next type of a planning technique, which is pretty good timing. But it is about the right timing, the right situation. And some people, they drag their feet for whatever reason. I might step on a few toes. Are there any engineers?
You can step on an engineer.
Engineers are tough, and real estate people are tough because they're always doing a deal. They're always doing a deal.
You can't read enough.
So we've talked about a couple of different things in terms of these charitable trusts. I want you to stop that thought process right now of you giving it to the trust, income for your lifetime, and then ultimately a gift to charity. I want you to stop that process for a second and think of this process. Asset, income to charity for a period of time. Remainder to family. Stay with me now. Asset, we can use the same thing here. This is what we're talking about now. We're on this Don't worry about what it's called. Same concept, all right? We got the asset being transferred in the middle here. Now, the function of this trust is to provide income to charity for a period of time. And when that's done, whatever is left in that trust gets distributed to children.
Jacqueline Onassis Kennedy did that.
Right. Why? Why in the world do something like that? Well, with this family that I was talking about, this fits very well because the children are pretty well taken care of. Grandchildren are an issue. When I say an issue, grandmom and grandpop would like to be able to do something for the grandchildren. Because what happens in this scenario, again, it's all a matter of taxes. It's a matter of transfer of wealth. When this happens, the IRS says, well, wait a second. You just made two gifts. You've made a gift of income to charity, and then you've given the remainder over here to your family. And what they do is they figure out the tax today. Now, I'm not going to get into all the details, but if you do it right, you can say that the value of the gift to charity is pretty much the same value as what you're giving because of the payout rate and the length of time. So it's conceptual that we can zero out the value of the gift to the children. So there's no taxes to be paid. But let's assume for a moment that you had to pay $1 million of tax. And let's just assume here that instead of $500,000, we had $5 million of, say, a business concern. And we expect that business to be around for 15 or 20 years. We also expect it to go up in value. And what happens is that if this thing goes up from, say, $5 million to 10, 20, $30 million, it goes to the heirs, income, gift, and estate tax free. Leveraging wealth transfer. When you're talking about people that are in that zone of having an estate well over $10 million, if you're under $10 million, pretty well, you can zero out your taxes because it's 5-5, okay? But for those people who are in that arena, and I don't know whether any, because I have ceased to try to look at people and say, oh, I've been fooled too many times. But for those people, this type of planning is incredibly, incredibly powerful as far as transferring wealth. And what we often see is that we'll combine this type of a trust and the charitable remainder trust. And so what you see here is you see a nice merging, if you will, of providing income for children, maybe grandchildren, and then lump sum distributions 10, 15 years down the road. And the end result is, getting back to that thing that we talked about before, they have choices of either taking family, government, or charity. And when you use these charitable tools, you have such a tremendous magnification of the wealth that is transferred, not only to the heirs, but to organizations that are deserving of support. So you got the last.
Couple more minutes on this, but what I wanted to chat with you about is that we're talking about charity, like St. Joe's or the Judy Caney Foundation, some established charity. You could establish your own charity. How do you establish your own charity? Well, you could be a Warren Buffett or Bill Gates and set up your own private foundation. Why do they do that? Why do you think people set up their own private foundation? Taxes.
Have a name.
Have a name. All good reasons. Kind of nice to have and say, hey, I have my own foundation. A lot of it is control. Remember, if you give it to a charity, the charity controls those dollars. So Bill Gates, the Bill Gates Family Foundation controls those dollars. So if you want specific things done with your money, then you can set up your own personal private foundation. There's a concept called donor advised funds, and it's through a community foundation. And it takes as little as $5,000. But it's exactly the same thing. You advise the community foundation as to how you want those charitable dollars spent. You can have that to $10,000, you can have that $20,000. So in the charitable gift annuity, you can literally fund your own charity. You can even point your children to the donor advised board to make recommendations as to how to spend those monies. It's a pretty amazing concept. So, and it doesn't take highfalutin amount of dollars. But you got to understand your goal. You know, what is your goal? What do you want to try to accomplish here? And then somebody can come in, give you alternatives, tell you about the cost. But, you know, when we start talking about giving money away, you know, what's the first thing somebody does? Go away. So, you know, but the thing of reality of it is you can't take it with you. So you have to understand the income tax rules, the IRD, income in respect to the decedent. And we're going to spend an hour and a half on this topic. But charitable, commercial annuities, when you pay your beneficiary out of a commercial annuity, they have to pay IRD, income taxes. Is do you give your beneficiaries your IRA, they have to pay income taxes. And many times between California and federal, it amounts to 35 to 40% to 50%. How long, on average, the average family here in the United States, how long do the beneficiaries take to spend your IRA?
Right away.
It's 18 months, no matter what the size. Which is kind of interesting because it's thought of as found money. You know, that you hadn't talked about it, nobody knows when you're going to die, nobody knows the amount that's going to be in there, and you can get at it, whoever's named the beneficiary can get at that money within 40 days after death, just by showing the driver's license. So a lot of times, those kinds of assets are spent rather quickly. A charitable gift annuity, if you have, let's say, someone who may need income over their life, you don't want them to have immediate those dollars, you can put a charitable gift annuity as the beneficiary of an IRA account after death, not during life. Does it cost anything? No. Does it require an attorney? No. You could say in the charitable, in your IRA or 401k, I want to benefit St. Joe's. I would go up before I died to St. Joe's and I would talk to Jim, and I said, Jim, what I'd like to do is when my son or daughter reach 60 or 65, whatever age you want, I want you, St. Joe's, to issue them a gift annuity. Can we do a memorandum of understanding in the file so once the money is received by St. Joe's that you'll issue that gift annuity?
Yep.
And Jim will say yes. Not Joe, Jim. But it's so simple. It doesn't cost anything. And now, instead of paying 50% in income taxes, 100% of the principal is earning that interest. So it may even turn out to be more financially beneficial to the individual versus getting it outright. The other thing I wanted to, one more minute, please hold on with me. We said practical issues on a CGA. Let's say my goal is just to save taxes. Philanthropy plays a very minor role. Be nice to benefit a charity, but I don't really care. Lots common occurrence. If you want to increase income, sometimes the best rates are at a charitable gift annuity, and you feel good about the fact that it ends up in the charity after you're gone. Reverse mortgages. I'd rather have it go to a charity than I would a mortgage company like Wells Fargo.
Yeah.
If you got Warren Buffett stock, doesn't pay any income. man, you can turn a Warren Buffett stock into income, no cost, getting income tax deduction. If you sell income property, we did this for another individual who had $20,000 coming out of 2 properties, and he was tired of tenants and toilets. He didn't want to deal with another tenant again the rest of his life. But he didn't want to give up that $20,000. And he wanted $200,000 in cash, bargain sale, in his pocket. So we put 20% in his name, 80% of the property in the charitable trust name. When the property was sold, $200,000 went to him, $800,000 went into the charitable remainder trust. It generated over $18,000 worth of income, and now I get postcards from him 5 times a year from everywhere in the world. I'm serious.
Now, another, just to add to that, the income tax deduction that was generated by the charitable component eliminated the tax that he paid on the part that he sold. You stay with me on that? It's very important, because what happens is that people can walk away with cash in their hand, tax-free.
And the last thing is, some beneficiaries just can't handle a lump sum. I mean, there are some families, and first of all, in every family, whether it's in the immediate, the grandparent, or the cousin, there is someone who cannot handle money.
Yeah.
And it's a great way to do a charitable gift annuity, providing them a stream of income over their life, and they can never touch the principal. Anyway. Jim?
Hey, thank you. Thank you for the opportunity. My pleasure. My pleasure.
Like you said, this class can go on for 3 hours. We don't have 3 hours. You don't have 3 hours. I know Bloody Marys are in the offing.
We're in on Fridays.
Thanks for being here. See you next week.